Hello and welcome to another edition of Mould on Markets. This is our regular look at the financial markets with our investment research director, Russ Mould. Russ, how are you?
Very well, Clara. How are you?
I'm not too bad at all. Now, as summer draws to a close, what is it that advisors and their clients should be thinking about?
Well, geopolitics continue to dominate the headlines. Whether it's virus in Africa, crisis in the Middle East, conflict in Ukraine, there's no getting away from these stories, and they're generally bad news, not good. And that is really... These are being used as excuses or explanations for why share prices have largely gone nowhere during the summer and bond prices have continued to rally quite hard. So if you look at the first chart behind us, this shows the S&P 500, Euro Stoxx 600 and FTSE All Share against the FTSE All World, and there's a pretty clear non-trend of things kind of flip-flopping around this summer. Contrast that with a second chart of 10-year bond yields, Germany, America and the UK. You know, it's like Franz Klammer, for those of you old enough to remember him, going straight downhill. And the German 10-year bond has actually gone below 1% for the first time ever.
So is this telling us all that a 5-year bull run on equities is running out of puff and that the bond bears were in fact wrong?
It's certainly one interpretation, and there has been a lot for clients to worry about. You've had India putting the mockers on a global trade deal. You've had Russia and Europe getting involved in tit-for-tat sanctions. Neither of those are going to help the global economic recovery. But equally, advisors and clients might be well advised to remember the words of Joe Rosenberg. Now, he's a legendary US investor, ran money for the Tisch family who run Lowe's for many years. And he said in 2011 to Barron's, you can have cheap equity prices and good news, can't have both at the same time.
Now that makes sense. So I'm guessing the message is to keep calm and carry on.
Yeah, panicking is never a brilliant idea at the best of times, and certainly summer's not always the best judge of the real market sentiment. It'd be much better to look at the autumn, when everybody's back at the desk. September will start to bring third quarter pre-announcements from the States, positive or negative. And also we'll get to have a look at what Super Mario Draghi's new monetary scheme in Europe gets up to. 400 billion euro targeted long-term refinancing operation, or TLTRO, to its friends. Let's see what impact that has. There'll be quite a few indicators that advisors can keep an eye on for their clients with regard to risk appetite on-off. The first chart here is high yield. It looks at 2 US listed high yield ETFs. Big sell-off in the summer frightened the heck out of everybody. Oh my lord, risk appetite's fading. That's rallied quite sharply. The next chart shows small caps. Russell 2000 from America, FTSE AIM All Share against the FTSE All World. They've been in a funk since March, consistently underperforming. Definitely a trend to keep an eye on. However, my final chart here shows the oil price in black and the gold price in red. Now, if you were really seeing markets in a funk, in a panic about conflagration in the Middle East, you'd have expected a lot more price action that you've had here and things going up rather than going down. So the fact that you've seen fairly placid markets there, and even apart from some oil price weakness, would suggest the market isn't moving into panic mode yet. They're probably a good lead indicator for whether the market is or not, and advisors will be well informed if they keep an eye on those.
Okay, thank you, Russ.
Thank you.
That's it from us. We'll see you next time. Goodbye.